somebody wanted to play the music again. We'll get into the deal highlights as far as some recent acquisitions and some cool things. That'll be the middle, and then we'll finish up with kind of the structured fund and how it kind of operates right now, what the terms are, and then we'll take some questions from the investors, from the potential LPs, from the listeners, and then we'll call it a wonderful Thursday. Sound good?
Yeah, it sounds good. Let's get into it. Let's talk about Q2. So obviously a big topic is tariffs. We're talking about interest rates in the market. And, we're being cautiously optimistic. We feel that interest rates are going to drop this summer. That's my prediction. That will help. The 10 years moving. We see a little bit of downward movement in the 10-year this past week, which helps. And we see a little bit more liquidity in the market. We've been refinancing deals throughout the United States within our portfolio, and we're seeing more liquidity in the market. So that's a good thing. I'm very encouraged by what's going on in the market, Chris. And I see the dynamics improving compared to the end of 22 and 23. In 23, like I said, we didn't buy any properties with a rising interest rate market. We see interest rates stabilizing. We see them eventually dropping. So I'm very bullish on it. You still have to underwrite the real estate fundamentals, and that's critical in this market. It's what separates us, Chris, compared to other sponsors or other real estate investment companies. It's really having that pedigree with 30 plus years experience of myself in the business and our leadership team with 200 plus years experience. It goes a long way in challenging markets. This is a challenging market. What I love about this market is chaos. When there's chaos in the market, there's opportunities. We see opportunities. We see lenders that are eventually going to start selling assets that they did take back with the trillions of dollars of loan coming due. So we see a lot of upside. This is a great opportunity for investors to get into commercial real estate. With the stock market fluctuating and all the chaos, hard assets, just like my book behind me, are the way to go to build wealth. So I'm very encouraged. I'm very bullish on commercial real estate, especially medical properties. Our medical fund is a great vehicle to diversify capital and really mitigate risk.
So I think, that was a good intro. I mean, obviously today we're seeing the dead cat bounce kind of play out the other way. Yesterday we had an all-time unprecedented move in the Dow on the heels of the announcement that certain countries that have been non-retaliatory were going to get a 90-day kind of stay to get deals done, and that was a big exhale for markets in general. Something is happening in the credit markets, which you alluded to earlier, that doesn't really make sense, but it has something to do with a basis trade around probably the hedge fund activity and some people being over levered. We'll not fully know, maybe, because the Fed had the closed door meeting on Monday, but the 10-year kind of moved up in a substantial way. Again, over 4. I'm trying to see on the Bloomberg right now where it's at. Today, I think it's kind of moving back down a little bit, but all that being said, I think when you talk about the general, you're saying that it's moving into a time where there's going to be deals in commercial real estate for those who have capital and cash to deploy and know what they're doing, and volatility is another reason why people will look to this asset class. I sent you the thing this morning, last question, and then we'll go into kind of some of the deployments you've made. One of the biggest malls in America, I think in Minnesota, it wasn't Mall of America, but it was something else, filed for a default today. So when you talk about the $2 trillion ish worth of CMBS maturing in the next 18 to 24 months, I mean, that's as big of a signal that that's not only real, but happening as you're going to get when the largest mall in a whole thing defaults on their loan and in a very public way.
Yeah, we saw that in 2008, 2009 when that fashion mall in Las Vegas defaulted on the loan. We saw that was the trigger that was a catalyst for opportunities out there. So I'm bullish. I'm excited. I mean, being in the prime of my career and being in this environment and seeing opportunities that are going to present themselves, I'm excited for us. I'm excited for our investors. I see great opportunities. I love these type of markets because it separates us. And, it stays the course. The reason why we've been in business for so long is really taking that conservative approach and underwriting properly and looking at the real estate fundamentals and not over leveraging properties. All these fundamentals I constantly preach and talk about is exactly what you need in an environment like this when it's chaotic. And it's through a test of time, that's that's how you survive and how you continue to thrive in markets like this, Chris.
Yeah. So let's talk about the new deals that happened in this last quarter. Coming up even into the end of March. We'll start with the Arlington deal. Let's talk a little bit about that acquisition, how it was structured, why it was structured that way. Let's go through some of the bullets on that.
Well, what I loved about that deal was the leverage that I was able to create when we acquired it. And what I mean by that is, when you have a fund like the Alliance Medical Fund, we came in and we were negotiating that deal for months. And the certainty factor was a huge play. When you have a fund, providing certainty to the seller was everything. It was a 12-year sale leaseback. And the leverage we created, we said, look, we knew we were picking up the property at a great price. We knew the rent was below market. We knew that the fundamentals were outstanding. We're right near the hospital in Arlington, Texas, a good, successful practice. We knew the motivation. They wanted to build a new 35,000 square foot facility in Houston where their headquarters were. And they were planning on using our funds to help towards their tenant improvement at the new property. So we understood the motivation. We understood the real estate fundamentals. And because we were in a rising interest rate market at the time, Chris, we realized we weren't going to surpass this deal, because if we put debt on the deal at the time we acquired the property, it would have been negative amortization, which means for everyone out there listening that basically the cost of our debt would have been a lot more expensive than the equity. And so we decided, and we said, you know what, we're going to pay all cash for this deal. And then months down the road, we're going to refinance. And so the other thing we looked at is when we walked the property, us and our property management staff, and we have an incredible property management staff, that we manage our own portfolio, which allows us to have complete control, to be able to negotiate contracts with contractors to keep our costs down for us and for our tenants. And what was exciting about that deal is when we walked the property, we saw a lot of things needed to be improved. And so we knew that if we make these improvements, we'll add a lot of value to the property. So we went through and we saw, okay, we're going to redo the HVAC at the property. We saw that there were some ADA issues with the ramp and how to improve it going forward with patients because they were extremely busy. And then we decided we're going to walk the property and redo facades and windows, et cetera. All those improvements have been done to date. And the tenant's thriving there. It's a 12-year sale leaseback, annual escalations. It's an absolute net lease. That's typical of what we negotiate, Chris, on our deals, where the tenant's responsible for all the costs involved. And we've done that a tremendous amount in this portfolio so far. We have a majority of portfolio of absolute net leases. And what that means for everyone out there is that the tenant is consistently investing money into the property. And so they're pulling the train in the same direction as us to continue to add value. They become more and more vested in the property, which mitigates risk for our investors.
Talk a little bit about that. Yeah, talk a little bit about that part for people who may not be familiar with why the tenant would do that, right? So in a sale leaseback, they're basically selling you the building they used to own, and they're continuing to operate their practice there. When they're investing in the business and the building they no longer own, why are they pulling in that same direction? Talk about what their incentives are.
I mean, let's start with the sale leaseback. A lot of times you see sale leasebacks because a lot of these physician groups got acquired by private equity or a hospital system. What ends up happening is there's a conflict of interest. So you'll have a group of doctors, they sell it to a hospital system as an example. And so what ends up happening is they mitigate and defer improvements and repairs and maintenance. And here's what happens. So let's say Dr. Smith out there sold his practice to a hospital system. He has a 20,000 square foot building. He's got to redo the roof. Now he's got to go to the hospital system he sold it to and explain to them why he's redoing the roof, where he wants to do it. And maybe it could wait a few years. So there's always this inherent conflict of interest between the landlord, who's the current doctor or physician group, and managing the property, and then also the tenant, who's the hospital system. They're saying they're looking at cutting costs and keeping their costs down. So there's always this inherent battle going on. So we see that frequently. There's a lot of examples why they do sale leasebacks: expansion, equipment. They want to use it, just like this example. The group that sold this to us wanted to use it for tenant improvements at their headquarters in Houston. So there's always a reason. And what happens is, because of the leverage, we say, look, you're going to be signing our lease with an absolute net lease where the tenant pays for everything. They even pay our management fees. We push our management fees, which help the bottom line and cash flow for our investors within the fund. And so an absolute net lease is critical to us, because we're saying, look, we're going to give you money up front, which is a financing type transaction, Chris, but we want to see that you are continuing building roots at the property and in your business, and you're going to continue to pay for these items to continue. So it consists of capital improvements, maintenance and repairs. They're paying taxes directly. They're basically saying, we want to be here and we're willing to pay the freight to be here and deal with an absolute net lease. So a majority of our tenants in the fund are paying absolute net leases. And what that shows us is a continuing, consistent investment in the property, which I'm excited about. And you know what? It makes it easier to finance. It makes it easier to make sure that your tenants are paying rent, because they become more and more vested over time into the property.
Yeah, I think it was a great example. And I think, a lot of people wouldn't have necessarily known all those reasons, even if they kind of understood what sale leaseback was, what some of the incentives are. I mean, totally makes sense. The incentives line up. The other example, I've heard you give, I think in the past, but you can add on as one more thing, is sometimes the doctors group has people of mismatched age, and they all own the practice, and the building is part of that practice, is assets. But the one person wants to retire, the other two are not ready, and they need to find liquidity to buy that person out. And one of the ways to do that is a sale leaseback as well, because they can sell off the hard asset of the real estate, lease it back, and keep the business going there with a partner like you, and yet they can get their old retiring person out of the day-to-day, right? I mean, that's another trigger.
It's exactly, there's so many different examples, but the real key is, in our transaction, is transactions don't happen unless you have a motivated seller. It will never happen in this business. And so we always want to find out. What we do is, what is the motivation behind this? Why are they doing it? Because that leads to, tell me about the condition of the property. Tell me what's going on in the municipality. I mean, one of the things that we do, and we'll talk about our new acquisition, which is relevant to this topic, is there's different items and ordinances that go on in these cities that can trigger sales, that can trigger lack of improvements going on. We'll talk about that when we get into the next acquisition we're going to talk about. But when you look at things on a holistic basis and you look at the real estate fundamentals, these are all part of the underwriting we do. The reason why investors invest with us in the fund, it's the little things we do. It's that experience. It's the leadership team. It's understanding, how do you prevent the train from coming, and knowing the variables to mitigate risk. And that's what we do. That's what we're outstanding at doing. And that's why, commercial real estate investing is a very experienced person's game, Chris. It always will be.
Very good. Let's talk about the next property, because there's some different angles there. And this one, I know, I mean, literally you're coming in hot off this one. This one closed a matter of days ago. And it was another big win for the fund and for Alliance. But Delray Beach, talk about that one. It was a unique deal. What happened? Why was it so down to the wire? Go to the glory days and the war story there.
Well, it was such a great, the location is tremendous, and it's Main and Main on Atlantic Avenue in Delray Beach, Florida, which you don't see a lot of assets in the Boca Delray Beach trading that often. So we picked up a great asset for our fund, and it's a 2-tenant building. It's a 3-story building, right? And it's got access to additional parking, which was something we had to get our arms around. We wanted to make sure we have enough parking. Whenever we acquire a property, parking in a medical property is critical. And so when we first saw it, we said, okay, well, looks a little underparked. Then we realized there's an easement for adjacent parking, so we have an abundance of parking, which is really a blessing. And so that started the deal to get us over the hump. The other thing is, the seller said, well, we'd like you to assume the loan. And we looked at the loan, and we realized that the loan was with a bank that we've done a tremendous amount of business with. I have a relationship with the president of the bank. And so I called up and I said, according to the documents, we could assume the loan. And it was interesting. The bank was, like a lot of banks, were looking to liquidate their commercial real estate portfolio. But they realized, with Alliance coming in, it would be better for them to let us assume the loan per the loan documents, than the current seller because we're a stronger borrower with a larger pedigree and experience. And so the loan was about 3.5 years left of term. It was about 3.63%. It was also a 30-year amortization.
Wow.
So the cost of capital, Chris, was tremendous. And we said, okay, well, the other thing that was really interesting was we got an evaluation. And the bank said, instead of an appraisal, let's do an evaluation. I think we paid about $9.6 million. The valuation came at 10.4. So we bought this property undervalued, which was great. And so the lender was thrilled at the value. You walk through the property. It's a gastroenterology facility, clinic on the bottom floor. You have a beautiful surgery center. It looks like a hospital on the second floor. And then they're doing procedures on the third floor as well. So significant heavy tenant investment in this building. The rents are a little bit below market. And so we picked it up at a great price with a lot of upside. And as we went through due diligence and we walked the property, I go to every single property that we've owned since the inception of my career. I always will. I'm a big proponent of kicking the bricks and mortar. And we had our acquisition guys out there and our property management folks as well. But I always make it a point to go see every one of our properties because I feel it's important to really use my experience to look at something that maybe someone doesn't see. And that's exactly what happened is we walked the parking lot. We said, hey, the parking lot needs to be milled down and improved. At closing, Chris, we got a credit for that.
Nice.
We looked at the roof. We said we need to let's do some repairs and maintenance and clean this up before we acquire it. We made the seller do that as well before we closed. And something that was really important is that one of the advantages we do is we really dig into the cities that we buy properties. We get to know them. We understand what ordinances are going to change, what's important. And so our property management, Chris, magnificently, they pay attention like we all do to understanding the city requirements, what new ordinances are coming. There's a new ordinance coming in Delray Beach in August that's going to be about elevators and safety. And so when we inspected the elevator of this building, we realized it's a little bit older. They just redid the cab. It looks beautiful. It works very well. But there's safety measures that the city of Delray Beach is going to be installing into one of their ordinances. And that's going to impact the age. And so what we did is we negotiated a credit with the seller to upgrade the elevator. Okay. We negotiated a credit of $150,000, which was a lot of money. And we're doing this. And right now we're bidding it out with the top elevator companies, and we'll be improving the safety of the elevator. And that's important because we have a lot of patients coming through the building. And as a landlord, you have a responsibility to the public to make sure you provide safety. And so that's what we did. So we had a lot of incredible things happen in this deal. It was really an interesting deal because what ended up happening is the lender said, they came to us. We went hard on earnest money. We're going to close on a Tuesday. I got a call on Monday saying, you know what? Because of FIRREA laws, we decided instead of valuation, we need an appraisal. And I said, what do you mean you have to do an appraisal? And so the lender got involved. The seller graciously worked at us, gave us an extension. There was a lot of negotiating going on. Are we releasing the earnest money? And I said, absolutely not. We're not going to put the fund at risk. We're not releasing earnest money to the seller. We're asking for extension. We just need another week and a half in order to close. Appraisal came back fine, close to the evaluation. Again, we're buying it below appraised value, Chris. And the lender worked with us because of our relationship, long-term relationship. So there's a lot of things that came out of this transaction.
There's a piece of that too at the end. I know it's a small detail, but I don't know that a lot of people have heard of it before. So you did what was called a dry closing on one day because either timing or something. Normally what would happen is you do a closing and the escrow would fund and the money's all simultaneously closed and go where they're supposed to go.
Right.
Why was it a dry closing, and what is a dry closing? Does that just mean
a dry closing is basically money doesn't exchange hands. Everyone signs the closing documents. Generally speaking, we do what's called the New York style closing. A New York style closing in commercial real estate is very commonplace where we'll deposit documents at a title company. The seller will and say we're the purchaser in this transaction, And
Yep.
then what happened was the following day, because we're waiting for certain things from the seller and from the city as well as the lender, the closing happened the following day. But the closing happened the day before,
Right.
which was April 3rd. The 4th, it funded. And so
Gotcha.
but all these little things come in play about negotiation. Are we reprorating rent and taxes, et cetera? There's so many nuances that go on. But what's really important to know is that with the seller giving us an extension to close, they're fighting us to take our earnest money
Right.
and wait for us. And I said, absolutely not. I said, if you don't show up to the closing or you default on the purchase and sale agreement, we're not releasing your earnest money. So I stood my ground and said, absolutely not. We're not doing
Well,
that.
and part of the reason why you had an argument there too was because you were assuming the loan, and technically the lender told you had everything you needed and then changed their mind. It wasn't really your fault. It
No,
was
it
the
wasn't.
yeah. So
Yeah, and
yeah, trying to stand up.
But for everyone out there listening, this is where experience counts. This is a tough market to close deals. Let's not sugarcoat it. And so with my relationship with the bank, I put in a phone call and I said, we signed a commitment letter. We are hard with $250,000 to close this deal. And I said, and we just made sure they were going to show up and close, which they said they would. But the relationship goes a long way. Relationships in commercial real estate are so important, okay, especially as you're doing deals. Also, how to navigate difficult waters. The fact that we are hard, which is also a synonym for non-refundable on earnest money, we're supposed to close the day after. We have to go to the seller and ask for an extension, okay? When our money is hard, it's not an easy conversation. So I had to get everyone involved in the transaction, sit everyone down and say, look, we're closing. The lender who they're using for a 1031 exchange after we sell them the property, they're using the same lender. They needed us to close. So I did such a behind the scenes deep dive. I was able to understand what exactly was going on in this transaction. I realized we had leverage. So I used that leverage and I said, we're not releasing our earnest money. By the way, the deal stands. I just need a week and a half to close because they're waiting for the appraisal to come back. And so, and then I got on the phone with the lender and I said, I don't really care what the appraisal comes back at. You're closing. You guys are going to live up to your word. They said, absolutely. We will honor it. Appraisal didn't really make a difference because it was pretty comparable to the valuation. But because of things change and ebb and flow in a deal, communication and control are so important. People ask, why do I deal with banks and relationships? It's the little things that go a long way when you're dealing with a bank. You know, if we were dealing with CMBS or an large institutional type lender, it's very challenging to deal with these challenges that come up in these waters. And so control is important, relationships are important, and experience is so important. And Delray Beach showed the experience and grit. I sent an email at 3 a.m. to my team and all our attorneys. We had over 20 people involved in this closing. And I sent an email as being the leader of this company, explaining my gratitude for all the hard work and resilience and grit that everyone put in to get this closing. And that's what it took. And it showed me who we are as a company and how strong we are. So really grateful for it. It's a tremendous asset. We're onboarding the tenants as we speak. They paid April rent, and we're off to a great start on that property. It's a great property for the fund. I'm really proud. I'm excited for our investors, and the fund's doing great. You know, we have great tenants. Everyone's paying rent.
So let's let's do a quick commercial here just for the people that may be wondering, and I want to give everybody a chance. Put your questions. You may have questions on some of the deals mentioned. You may have questions for Ben just on the market in general. You may have questions related to the fund dynamics, which we're gonna talk about how the fund works, how the preferred returns, all that stuff, so that you have that detail. And make sure you check out the book. If you haven't gotten yourself a copy, you can go right here to this QR code above my finger. You can scan that one. If you want the intelligence and the newsletter, which is tremendous, a little over, I think, 10,000 subscribers and about to add another 20,000 from this last week, are getting Ben's insights every week on Alliance Intelligence, which is the newsletter. You scan that QR code below me and you can get that. And then you'll find the academy through that too, where you can build out your hard asset empire blueprint and learn, bring the book to life. So a lot of amazing value that you can get to kind of dive into this a little bit more and work on your own understanding. But let's talk about the fund. So you have investors in the fund. Let's talk about the terms of the fund. How much is left, meaning how much money you are still raising the fund or not. If there's because I know it's almost oversubscribed, or it's potentially there. I'm not sure, but talk about that, and then the details of how the fund is structured. I know there's different preferred returns based on the medical versus multifamily. So go into some of those details, and then we'll take some questions from the audience.
Yeah, I mean, so we have some money left to raise, which we will. Our investor relations are working every day. We have a lot of investors interested. We also have the ability to increase the fund from 50 million to whatever we decide based on demand. So we've had a lot of new investors, Chris, come in because they like diversification. There's 4 benefits to the fund. Okay, number 1 is cost of capital. We get great, especially in this market with loan constants and where they were rising to. We get great cost of capital for having a fund because we can give lenders repeat business. It was the same thing with Delray Beach, is the fact that we had a fund and we had other assets. They loved it because they realized, they said, look, as a guarantor, the fund can come in and guarantee the loan if they have to. The fund has over $11 to $11.5 million of equity in the fund. A lot of strength. So cost of capital is the first one. Number 2 is scalability. When we sell an asset within the fund, we could do a 1031 exchange and leverage to buy more assets without going back to investors for more capital. So scalability is number 2. Number 3 is diversification. Diversification is tremendous to have a fund that will have approximately 20 assets. So if someone out there listening, you haven't invested in the fund yet, let's say you have $1 million. If you amortize over 20 assets, you're for 50,000 assets. You could look at it that way. When you invest in the fund, you own a piece of every single asset in the fund. You invest at the fund level, which is Alliance Medical Fund I LLC, and then the fund owns every property within the Alliance Medical Fund. Every property is put in a separate LLC for tax purposes and liability purposes. Every property, if there's a loan on the property, they're separated out. So liability is important. So diversifications is extremely important. So we got cost of capital, we have scalability, diversification as well. That's really important for the fund that I'm extremely proud of. And the other thing that the fund offers is pricing certainty. If you look at the Arlington, Texas deal, and even the Delray Beach deal, why we got such good pricing is forget about Alliance's pedigree and our experience and the rapport building we do on the phone. It's the certainty that we're going to close. In this environment, Chris, with this chaos, okay, and lack of liquidity that's happened in the last 2 years, providing certainty gets you great pricing. That's a real benefit to invest in this fund, is having assets where maybe you have pricing below replacement costs, et cetera. So, the fund's a 5-year fund. We have the ability to extend it. Our investors come first. It's all about the ability to hold. We'll look at the market before we sell it. The reason why we established the fund is a lot of institutions said, we want you, Alliance, to roll up a group of properties that you could sell to us and we'll pay you a premium. And so, again, it's a tremendous vehicle. Let's talk about investor level, like how the returns work. So there's 3 classes within the fund. If you haven't seen our documents, and if you're a current investor, you know this as well. So a Class C investor is $1 million or $1 million or less commitment. You get 6% annual preferred returns paid quarterly. A Class B investor is $1 million to $2.5 million investment. They get a 7% annual preferred return. And a Class A investor is a $2.5 million or more investment. They get an 8% preferred return. Generally speaking, we'll pay a 6% current and we'll accrue anything over that if necessary. And then upon a sale, our investors will get up to first 12% internal rate of return. They get 60% of net proceeds. We're 50-50 afterwards. We're projecting a high teens internal rate of return. That looks like about a 2.25x on your money within 5 years. And that's what we're projecting. And
So a couple questions. This very,
well, let me add one more thing I think is really important. We do not believe in over leveraging our properties. Generally speaking, we're 65% or less on our portfolio. And so each acquisition that we have, we're very conservative. We look at maximizing returns with leverage, but we want to make sure we're not over leveraged. I am a big proponent of not putting leverage on a property, over leveraging a property. And so that's kind of the Alliance way, is very conservative type investing.
Yeah, and I mean, you gave an example earlier. That was one where you purposely chose the fund, basically bought the thing with all cash. You'll refinance later at a cheaper rate. In the opportunity where you assume the loan on the Delray one at 3.36, I mean, that cost of capital is long gone. I remember those days of 3.36. We're a ways away from that again. So that's a hell of an acquisition with I think you said there was 3.5 years left on that. So with a 30-year amortization of 3.5 years, I would imagine that when you look to refinance that, rates should be in a lot more healthy range, if not right back down there, depending on the macro. But in the meantime, you've bought yourself enough runway. So that LTV, that was Ronaldo's question. You kind of hit that on the head. He had a follow-up, so we'll just go there. What is the exit strategy and hold period? I think you touched on it. 5 years.
Yeah,
5 years.
It's just speaking the fund's about 5 years, but if we need to hold it for another year or two, we will, to maximize returns and mitigate risk for investors. Generally speaking, we're looking at 5 years or less. But just to answer Ronaldo's question was, we'll probably look at selling properties intermittently within the fund too. And so we'll have a choice. We'll look at the metric and say, do we return capital, which we'll look at doing, or do we do an exchange and really diversify and help? So either way, we're going to look at the risk factor and figure out what's best for the investors. Investors always come first. Steve Smith asked, which is a great question. Yes, if you do invest in the fund, you will own a piece of every single asset in the fund, because Steve, you invest at the property level, and the property at the fund level, excuse me, and the fund owns every single LLC, which is what the properties are based on. So every asset in the fund has the address in the name. We'll say Alliance 6646 West Atlantic Avenue, and the Alliance Medical Fund is the sole member of all the LLCs in the fund. So yes, it's a great question.
I want to clarify something on that, because this is something that I think is really interesting about where you're currently filling out this last portion, or oversubscribing it, which I don't want to get wrong. So just correct this. But to Steve's point, am I accurate when I say that the fund right now, which has a bunch of assets already in it, there's a bunch of properties that are already in it. The trigger for the new investor, let's say one of these guys invested today, and let's just say they were at the 8% preferred level. So they came in with $3 million, whatever it was.
Right.
If they came in on that, their money has to be put to work before they start their pro rata.
Yeah.
The minute their money's put to work, they still benefit from the retroactive assets in already, right?
Exactly. That's the benefit to them. So let's just say he invests $3 million. Okay. How the preferred return gets calculated, I want everyone to hear this, is the date of the settlement date, okay, is when your preferred return for that amount of money that was deployed out of your $3 million. So let's just say he deployed $1 million into that new acquisition. The $1 million gets calculated, his preferred return, the 8%, on the date of settlement. Okay. Now, we call all the funds up front. We put it in a JP Morgan escrow account that's earning interest. It used to be 5%. It could be a little bit less now with what's going on, but it's got a decent interest rate. We calculate that. We pay that out as well. And then we start deploying money, and the preferred return starts calculating. And so we have an entire, Chris, fund accounting and administration department that works with our CPAs in Chicago, where our headquarters are. And so our fund accounting administration, they do all these calculations for every single investor all the time. It's why we have a heavy staff of fund accounting and administration. That's really important. So it's a very well-oiled machine, a lot of experience in this fund.
It's also an important piece there of the capital being put to work is dependent on you having the right deal flow, right? So again, these are other advantages. I'm just calling out as things that people might want to, when they have a one-on-one with you. We got the number down there. You can also call or email Carla to get an appointment if you're interested in that. I mean, go to the website and click on Invest with Us, and you can set an appointment with Ben directly. So encourage anyone who's going from curious to serious to do that. But a couple of the things that just help save some time on those too is that your deal flow right now, I think you said, this next quarter, you've got an eyeball on maybe 2 to 4, closings. Obviously, you have more than enough deal flow to look at more than that, but you're also leaving some gap. This was our conversation in the green room, but I want to fast forward to it and have you comment on it. You're leaving a little bit of gap in that because you're opportunistically waiting for the phone to start ringing because you think the phone's going to start ringing from your network of brokers and bankers, given these market dynamics. And so you kind of have more than enough known and also probably forward-looking deal flow to put money to work relatively quickly and get those preferred turns kicking in. I think that's
I mean, absolutely. I mean, the fund is strictly medical and veterinarian properties. Okay. It's not other asset classes that we invest in. So the fund is strictly medical and veterinarian, and we look for the best assets. So that's the bottom line is what are the best assets out there that we can acquire? How do we mitigate risk for our investors? And so if you look at 2023, I told my staff, I said, it's highly likely we're not going to buy a deal this year because the numbers aren't going to pencil out. There's too much risk in the market. So the investors always come first, Chris. And it's not about generating fees. It's not about, building our net worths or anything. It's about the investor experience. One thing I'm very proud of, if you look at our investor relations department, is that 7-star experience that I talk about, the white glove service, that's so critical to me. That's why we've been in business for 3 decades and we thrive in what we do. And so I'm also, for everyone out there, I don't think a lot of people know this, I'm also a CPA. And so I got my CPA when I first came out of Indiana University School of Business, which was one of the top business schools when I was there. And we look at the tax benefits. So the tax benefits, so everyone knows, is tax benefits are always at the property level, and then they flow down to the investors. And so you have depreciation, interest expense, property taxes, and you can mitigate taxes. So my goal is always, if I'm paying $1 in cash flow, how do I get the investor's ability to pay taxes on 80 cents of that dollar, maybe 75, whatever it takes? And so we look at accelerated depreciation, cost segregation studies. We meet with our accountants on a frequent basis to look at these deals. If you look at Delray Beach, the process is already starting. How do we mitigate the tax? How do we increase the tax benefits, mitigate risk, and also look at what's the impact of these tax benefits going forward in the future? I'll give you an example. In 2022, when we started buying assets, we bought some assets at the end of the year. We accelerated depreciation, which was beautiful for the fund, is the current investors in that were able to receive a paper tax loss that they were able to use against other passive investments they had, because we bought the property at the end of the year. The cash flow didn't really start yet, Chris. And so we were able to create a loss because there was more depreciation than cash flow that came in when we bought the properties at the end of the year. So we look at all these different situations to figure out how are we going to maximize tax benefits for our investors.
Yeah, and that answers Garth's question, I think. And assuming, again, the pro rata pieces, the depreciation across all the properties is going to be on different schedules. That's going to roll up. And then the pro rata portion of the total AUM and what my investor check is going to decide what my tax benefit is off of that portfolio, correct?
Yeah, and we just got out K1s for the fund, which I'm really excited about. We got them out really early this year. I believe it was at the beginning of March. I could find out from David Milan, who runs our investor relations department. We got them out really early. It was the first ones to come out for our investors. And also just let everyone know, every single quarter, I write a personal letter to you if you invest. We also include a narrative, which is basically a summary of what's going on in each property. We're going to talk about capital improvements. We'll talk about any challenges to deal with at a property. So full transparency is extremely important. And then we provide financial statements of the fund at the end, so you can follow along and see what's going on in the fund. Transparency is one of our core values: transparency, integrity, consistency, and expertise. That's what you get, investor. And we give our investors 7-star experience. We were one of the first companies in the United States to create an investor portal. Now it seems like everyone has one. We're doing online banking and everything for our investors. And so your distributions are dropped directly in your bank account. We don't touch your bank account. Our investor relations department will help you set up your own account on our portal. and you put your own banking information in, so everything's confidential and secure. We're big into privacy as well as data security as well, Chris. So all these things are discussed, and it's interesting with my new book, Hard Money and Hard Times, hard assets and hard money for hard times. We talk about all these things. We talk about insights of how we run Alliance, and so it's a really good way to learn about it. So if you have,
I think it's a great way to learn about you, your frame, your blueprint, your kind of way of looking at the world. Obviously, you don't want to put any friction in the way of someone who's looking for a great home for some capital in today's time. So we have your number down there. They can get in touch with who got them on this, whether it was Ted or one of the other guys. They can call you directly. They can email you or Carla, set up an appointment. So encourage anybody, especially the great questions that got asked today. Get in touch with Ben and kind of have a one-on-one, talk about your specific situation and figure out what's right for you.
And look at David Milan just chimed in. Thank you, David. K1s for the Fun came out at the end of February. So there you go. Very timely. So yeah, it's white glove experience, 7-star experience. Lots.
We'll blow that one up on the screen so that one gets highlighted in the YouTube.
It's tremendous. I'm a big fan of making sure we're prompt and responsive. And what I love about our investor relations department is they're in constant communication with our investors, and we over communicate with them. So really proud of the people at Alliance. We have tremendous staff. And if you want to learn more about me, you can go to benreinberg.com. I also have a TV show that is produced that you can watch on YouTube. It'll be streaming as well. So I am all over social media. I'm constantly educating. With the book, you get a blueprint. And I wrote the book for you. I didn't write it for me. I wrote it for the public because I wanted to give back for my legacy and create impact. And one of the ways that we're giving back is teaching how to build a hard ass empire. So whether you're out there listening and you're Ben Reinberg from 32 years ago getting started, or you're a billionaire, this book is for you and your family. Okay. Every one of my kids I've given this book to. And there's a reason behind it, because I wanted them to understand how to build a hard asset empire where they can pull it off the shelf and they can look at it every week, every day, every month and say, how do I manage all the details? We're teaching people how to build a castle and all the variables that you need to do. It's actionable and it's a visual book. And we've had thousands of people already order it. And a lot of CPAs and registered investment advisors and professionals, accountants, attorneys, you name it, are ordering in bulk so they can give them out as a gift to their clients. And so very excited about it. And it's a great read. It's a way for you to get an insight of what we do at Alliance, who I am, and our philosophy. So feel free to pick up a copy. You can go to benreinberg.com. Some people like to go to Amazon and Barnes & Noble. You can buy it there as well. So it's all about giving back and helping people.
If you want bulk, you're doing great discounted deals on the bulk orders, and you're signing them, and you're doing a bunch of things. So that that's also available at benreinberg.com. I'm holding my hard copy right here. It is next to 5 other books. One is Art of War. One is my book, because I got to have it next to my book at least. But then the other one is Artificial Intelligence and Think and Grow Rich and Elon Musk. So you're in good company next to my bookshelf, my friend, and well deserved. Nice. I mean, I think it's a tremendous asset. And this came out March 25th, so this the paint's not even dry on this thing. I mean, this is literally new. You guys are the first ones to get it. So anyway, that's a heck of a webinar. There's a lot of value in that webinar. Thanks, David, for the comment there. Thanks, guys, for the questions. Follow up directly with the rest of yours, and we'll see you guys next time.
Yep, absolutely. Take care, everyone. Have a great weekend.